is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Debt talks set to intensify in search of a framework agreement, while President Biden is cutting short his upcoming trip to Asia to be in D.C. for the negotiations. Fed officials diverge on whether a pause or another rate hike is warranted at the meeting in June. U.S. futures actually point higher, plus a major change of strategy for Tesla. Elon Musk reveals the electric car maker will buy traditional advertising for the first time. Now, let's check in on the markets at 9 o'clock here in London. So markets have been open for about 1 hour. If you look at market, trajectory, stocks seem a little bit mixed as we look at that U.S. debt ceiling. So anything that will happen from there, of course, will move some of these European stocks. 0.3% lower for European stocks overall. Of course, if there is some kind of volatility in stocks as we get nearer and nearer to the debt ceiling, debt line, this could have a huge implication not only for funding, issuance of corporate debt, but also some of the contracts that may or may not work. Watch out for any fallout from the banks. The U.S. two-year yield 4.0823. We had JP Morgan Asset Management earlier on saying that they're expecting a cut from the Fed. Our Dan Curtis is also working on a great chart looking at exactly what of the big banks are expecting a cut or not. I think we have about 3 and 3 of those that are expecting cuts, so believe in the markets, and the ones that don't. And then the other big story is, of course, everything that's happening in earnings. So let's get onto the European map to see whether there is a big difference. Sometimes there is, sometimes there's not. You can see the outlier is actually the DAX gaining 0.1%. We did have some encouraging figures out of Commerzbank, so that's giving a little bit of a boost to that index. FTSE MIB and also the CAC 40 down between 0.3 and 0.5%. Now, debt ceiling negotiations between the White House and congressional aides are set to intensify as President Biden heads to Japan for the G7. Now, Biden and Republican lawmakers held the latest round of talks yesterday, saying that while the two sides remain far apart, they were hopeful that a bipartisan deal could be struck.
We just finished another good, productive meeting with our congressional leadership about a path forward to make sure that America does not default on its debt for the first time in history. There's still work to do, but I made it clear to the Speaker and others that we'll speak regularly over the next several days, and the staff's going to continue meeting daily to make sure we do not default.
For 97 days, the president ignored us and said we couldn't meet. It wasn't until the Republicans would no longer ignore the problem and actually raise the debt ceiling, pass a bill, did we finally get a meeting.
Well, on the debt ceiling, let's go straight to Bloomberg's John Hersowitz in Tokyo. So, John, how close are President Biden and the Republicans to an actual deal?
Well, Biden left the meeting saying that he was cautiously optimistic, and House Speaker McCarthy said that things could come together quickly. But while there was this positive tone, both sides also indicated that there are still huge differences to overcome. And history says that a deal gets reached, but there are jitters in the markets. We saw a slide in stocks and bonds in the U.S. because of the uneasiness about what's going on with these debt ceiling negotiations.
So President Biden has also been forced to cut short his upcoming foreign trip. Are there any diplomatic consequences because of that?
Yeah, I mean, the debt ceiling negotiations are going to hang over Biden when he comes to Japan for the G7 summit, which starts officially on Friday in Hiroshima. Biden's going to be arriving on Thursday night for meetings with Prime Minister Fumio Kishida of Japan. But he's also had to curtail planned parts of this trip, which included a trip to Australia and also to Papua New Guinea, which would have been the first by a U.S. president. Now, this upsets the U.S.'s Australian allies and also Pacific Island nations, which are caught in a bit of a limbo with China trying to woo them and the U.S. and Australia trying to make sure that they can continue their presence in the region, worried about China's assertiveness in the waters in the Indo-Pacific region. So that's at one end. Biden has tried to smooth things over. He's issued an invitation for a state dinner for Prime Minister Albanese. No date's been set for that. But this cutting short the trip, it really could hurt some of the U.S. efforts to take on China in the Indo-Pacific.
Really interesting. John, thank you so much. John Herskowitz in Tokyo. Hopefully some of the allies will look actually at the debt ceiling, and we have a great chart looking at how much cash the Treasury has left. Again, there are also mutual agreements that it's unclear exactly when the debt ceiling comes to an end, but you can see the Treasury's cash balance has been dropping quite a lot. We understand that they have $87 billion left. Now, let's also talk to Zoe Gillespie, portfolio manager at RBC Brewin Dolphin, to see the way forward for the debt ceiling. Zoe, thank you for joining us. You look at that chart, you look at the money left, and you say, look, at some point, good morning, if there's not a concrete agreement between the two sides, there's going to be a problem for the markets. How do you work around that? What's the right way to look at portfolio building now ahead of a possible cliffhanger?
I think that the first thing to say is the markets have had a fairly sort of muted response so far to this, and we haven't really seen any massive swings in the S&P for the last few weeks, and a sort of 1% either way. And so I'm not sure if the market's pricing in some kind of resolution, and I think certainly 70% plus of fund managers think we will get a resolution. However, as it nears kind of the line, I think we may start to see, potentially gold tick up a bit. We may see a run for treasuries. And I think short term, we may see a kind of flight to safety in a risk off mode. But at the moment, it doesn't seem to be filtering through to markets just yet.
So what does that mean for, though, how you want to preempt? I don't know whether you buy gold or you buy something else just in case, or do you wait until there's turmoil to decide what to do?
Yeah, to be honest, we're kind of long-term kind of how we position portfolios. And I think, trying to deal short term, I think is always difficult. And I think at the moment, I think we're pricing and there will be a resolution. So I think on balance, we have a sort of slight underweight equity stance anyway. So we're still kind of cautious about how we're positioning portfolios. But I think if you are looking for something that's potentially going to give you some safety, there may be a flight to these kind of assets in the coming days and weeks until we do get some more clarity.
So if there is something with the debt default, I know longer term it could actually have a huge or pretty big impact on dollar. Does that change the way that you view dollar going forward?
Yeah, I mean, I think the dollar has had, obviously, it is still the dominant sort of world currency, and we've seen it sort of weaken over the last few months. And I think potentially, if there is a default, then it's going to have a massive impact on the dollar and certainly confidence in the US economy as a whole. So, but I think certainly from our perspective, from an investment case, we're still have a sizable weighting to US and trying to see past this and sort of look longer term. And the quality of businesses the US still has is still appealing to investors.
So what's your take on actually, I mean, the big debate, of course, is whether we see a credit crunch or not, and whether that gives the markets more impetus to really believe in a cut from the Fed, or whether the Fed will really have to push back and try and jawbone that to make sure that the market believes them when they say no cuts are coming. Do you think there are Fed cuts coming by the end of the year?
No, we're still kind of think that we're still believing what the Fed says, that there's not going to be cuts coming. And I think if you look at inflation, it's still higher than target and it's still been sticky, albeit it has been coming down. Jobs or data in the US has still been strong. So I think the chances of the Fed pivoting sooner rather than later is not really how we see it. And we're still seeing that we think that the chance of a soft landing are still there, but we think there's going to be a mild recession coming into the sort of second half of the year. And I think that kind of potentially could give rate cuts into next year. But at the moment, we still think the Fed will hold. We think inflation will still be the problem that they're going to kind of focus on. And I think until we see sort of meaningful inflation coming down, that we think that the Fed will hold rates higher for longer.
Yeah. So are you constructive actually on European equities? I know that they've had a pretty strong rally since autumn, but if you talk to US investors, they still think Europe is burning. So I don't know whether there are opportunities there.
Yeah, I mean, we've seen sort of European equities have recovered, and I think the fall in gas prices has helped the economy as a whole, and we're getting CPI data out today. We have certainly have a weighting to European equities, and I think a lot of the European strength has been largely due to the luxury goods sectors. We've seen likes of LVMH sort of dominate the news recently, but I think longer term we've still got a higher weighting to the US, and we still favour it as one of our kind of main markets.
What's your take on the UK? Again, they've had a tough ride, but so if there's a path forward for growth, then maybe this is a good entry point.
I think the UK was one of the sort of standout markets last year, and I think a lot of that was to do with the fact that they had such a high weighting to the energy stocks, which did well, and it was a value play, and a lot of the UK sector had underperformed significantly for a long time. And I think there's always been a bit of a disconnect between the UK economy and the FTSE 100 due to the fact that it has such an international weighting. And I think the dollar weakness has kind of impacted on the FTSE strength, with most of their earnings coming from overseas. So I think the UK economy, the data has been slightly better, but if you actually look at it, it's still predicted to have slower growth than many G7 countries. So there's sort of bit more optimism, but I think the market in general, we've seen more of a sort of switch to more growth style kind of businesses. And with the energy sector coming off, we're sort of less sort of positive on the outlook for UK equities this year.
Zoe, maybe just a final question on Asia, given that President Biden had to cut, shorter his trip, also to go back to the debt ceiling. What do you buy in some of the Asian stocks right now?
Well, I think Asian stocks have been, very receptive to the reopening story. And I think certainly, again, that feeds through to what's been playing the European space. So I think certainly from Asian markets just now, that we've not really seen much coming through in terms of data for manufacturing and for exports has been slow. So I think if you look at Asian markets, Japan's probably the standout just now that's certainly done better, and probably at the moment is getting more of this sort of favourable news flow. But I think with Asia, we have been more cautious, and to be honest, we have been playing it more through luxury goods sort of stocks rather than anything. And I think certainly going to the sort of second half of the year, I think we'd need to see a sort of notable tick up in sort of manufacturing data and output and industrial output before we're more keen on Asian stocks.
Zoe, thanks so much. Zoe Glepsy, their portfolio manager at RBC Brewin Dolphin. Coming up, Wall Street's biggest banks face a harsh reality check in China. That's the subject of today's Bloomberg Big Take. We'll bring you that story next, and this is Bloomberg.
When I think about the trajectory of inflation, I think that we've made a really good progress on that.
Inflation is down and continues to make progress. It's not as fast as we wanted it to, or we expected it to be.
I also want to reduce inflation, and if more increases are what's necessary to do that, I'm comfortable doing that.
If you think about where the economy was and where inflation was last summer compared to where it is today, we've seen really positive things happen.
We should not be fooled by a few months of positive data. We still are well in excess of our 2% inflation target, and we need to finish the job.
Fed officials weighing in on inflation at the Atlanta Fed's annual financial markets conference. Now, let's talk football. My favorite, apart from talking inflation, the Qataris have made an 11th hour bid for Manchester United, we understand, to see off Jim Ratcliffe. Now, we did actually, just a couple of days ago, say that they would not really want to offer more. So this is an improved offer, but it was really at the last minute because bidders were invited to submit their final offers to New York bankers overseeing the sale last month. We understand through multiple sources and our very own people on the ground that at the moment we thought Ratcliffe and his team at Ineos had emerged as strong favourites to buy the club from the Glazers, and now the Qataris have come in with an improved offer. The share price, Manchester United pre-market, 6.4% higher. Now, let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The EU and UK are reported to have agreed to work together on curbing migration on small boats crossing the English Channel. According to the FT, Prime Minister Rishi Sunak and Commission President Ursula von der Leyen agreed that London will cooperate with Frontex, the EU's border agency. The leaders spoke on the sidelines of the Council of Europe summit, which is happening in Iceland. Now, Japan's economy grew at a faster pace than expected in the first 3 months of the year, as a further easing of pandemic rules really boosted consumption. GDP expanded at an annualized rate of 1.6%, the strongest growth in 3 quarters. The data will add to speculation over the prospect of an early election. Now, Jamie Dimon says JP Morgan is unlikely to purchase more struggling regional banks. The CEO told JP Morgan's annual meeting the banking industry was hopefully coming back to stability. JP Morgan bought First First Republic Bank earlier this month after it became the second largest bank failure in US history. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thank you so much. Now, Wall Street's biggest banks face a harsh reality check in China. That's the subject of today's Bloomberg Big Take. Now, the bank's plans to compete for a bigger share of the country's $60 trillion financial market, and they're facing challenges. Bloomberg senior reporter Kathy Chan joins us with the very latest. Kathy, first of all, congratulations on a big take. It's the one that everybody wants to read about as we try and figure out what China does next and the role of finance in this. So why are Wall Street banks pulling out of China now?
They're not really pulling out, but they are definitely thinking about scaling back. I mean, right now we only see them cutting jobs. That's the main thing they're doing right now. Think about the deal market right now. It's pretty much frozen. Look at the data from China yesterday. It was pretty bad. It kind of confirming the China reopening is not really helping lifting the global sentiment. And the U.S.-China's tensions continue to escalate. That was kind of like a little bit unexpected. So the bankers are telling us that there are a lot of deals out there. It's just they're sitting on that. It's just no way they can execute because the global investors are not buying into China. Look at the net inflow into China is pretty low or minimal, right? So no buying interest, and they are not cutting prices when issuing stocks. There's no deal, so they have to cut. Make more sense, right? So,
Kathy, first of all, are you expecting more job cuts, actually, in that region from Wall Street?
Definitely. We're hearing more. I mean, we thought they were pretty much done after last round, and then there will be more. We report about JP Morgan Stanley yesterday. They're starting this week, and there will be more, especially the international sentiment towards China is pretty bad. We just think the life of the international investor dealing with China is pretty bad right now. So
you're the expert in this. How much is this actual, lack of business, and how much is this a worry about regulation crackdown on certain finance? Are they kind of walking a tightrope, and are they still committed overall to China?
It's very much both, like regulatory crackdown, which is kind of a little bit away, sort of like past already. It's more about the geopolitical tensions and the economic situation in China right now. I think the commitment for the Wall Street Bank is still there. It's just such a big market. Think about the investment they made, over $50 billion like exposure last year, and then another $4 billion invested into the size of the stakes. I think those are sunk costs. They have to stick around. I'm waiting for market to come back. Worst case scenario, if China, most of China is being sanctioned, they probably have to pull out. But I don't think that scenario is likely to play out anytime soon.
All right. Thank you so much, Kathy Chang, with the very latest, of course, on this Big Take, which is a fantastic read. So we'll also push it out on social media, and everyone who has a Bloomberg terminal has to go and read it. Coming up, a Tesla boss, Elon Musk, says the EV maker will dabble in advertising. We'll get more on the company's latest marketing shift next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Tesla boss Elon Musk says the electric car maker will dabble in advertising, a major shift for the company that's largely avoided traditional marketing. Now, joining us now is Bloomberg's Elizabeth Berman. Elizabeth, so has Musk actually done enough to reassure shareholders?
So Tesla held its AGM late in our time last night, and shareholders were looking for some reassurance about him being spread too thinly across his many interests, namely Twitter, SpaceX, and of course Tesla. And he partly already reassured them by appointing a CEO to Twitter. But he's going to remain quite hands-on there by remaining in an executive chairman position. And then on another point where investors are always looking for a bit of a process is succession planning. There was one motion to get a public plan for that, to which Musk only replied that he had no intention of stepping down anytime soon as CEO.
So how significant is the decision on advertising?
Yeah, it's a big shift for the company, but it also tells us that the story of where Tesla is at these days. They've become a mainstream car company. They are set to make some 1.8 million cars this year, if all goes according to plan. That's just a little bit less than BMW, for context. At the same time, there's a lot more competition these days for EV buyers. So far, Tesla has relied on word of mouth and, of course, Musk's larger-than-life persona, namely on Twitter. But now markets are weakening. Tesla has already cut prices massively on its vehicles. So this really does appear to be the next logical step. And of course, it's going to be really interesting what kind of advertising they go for.
Yeah, thank you so much, Elizabeth Berman, there with the very latest on Tesla. And also, of course, Elon Musk, and therefore probably Twitter, the read across. Coming up, we're in conversation with the president of the British Chamber of Commerce at the Business Organization Annual Conference. Our Lizzie Burden is on the ground speaking to Martha Lane Fox. That's next, and this is Bloomberg. Debt talks set to intensify in search of a framework agreement. President Biden cutting short his upcoming trip to Asia to be in D.C. for the negotiations. Fed officials diverge on whether a pause or another rate hike is warranted at the meeting in June. U.S. futures point higher, plus a major change of strategy for Tesla. Elon Musk reveals the electric car maker will buy traditional advertising for the first time. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, let's look at what the markets are doing. First of all, global markets are pretty much trading a little bit mixed this Wednesday. Risk-taking tempered by disappointing data out of China. Inflation numbers also weighted in Europe, and a deadlock in Washington when it comes to, of course, talk of the debt ceiling. I have to say the anxiety that leaders in Washington are feeling will be unable to stave off this historic default before June the 1st deadline is starting to unsettle markets. There is bond issuance that is traditionally lower for the month of April. This has been brought forward, I guess, so that they have enough funding to contend with whatever happens. Negotiators are seeking some kind of framework now to review when President Biden also returns from a shorter trip than expected to Asia. The other thing we're looking out for is, of course, Treasuries pretty much steady. Then Tencent, we're expecting Tencent to come out with earnings very shortly. As soon as that's out, we'll bring you the very latest. Former British Prime Minister Liz Truss has warned of the threats to the West posed by China. Now, she's calling for more support for Taiwan during a visit to the self-governing island. It's the latest intervention on China by the UK's shortest-serving Prime Minister. Let's bring in Bloomberg's Rebecca Chun-Wilkins. Rebecca, you wrote a great story today, and I have to say I had to read it twice. We knew that she was going, but still, it's just bizarre. In the middle of this huge, awkward fight between the U.S. and the U.K. and China and Europe, that Liz Truss, of all people, were to turn up in Taiwan. How critical is this?
Yeah, I mean, she's definitely sort of inserted herself very firmly into the conversation, some quite fiery rhetoric there. In essence, she's saying that China cannot be trusted. In her own words, you cannot believe a word they say. So some criticism there, of course, speaking to this concern that British engagement with China has failed, but also criticising European nations, saying it's completely irresponsible for them to wash their hands of Taiwan. So again, tacitly levelling criticism at leaders like Macron, Schultz, who have sought to reset ties with China in recent months. Now, whether or not it's sort of substantive, I think there is a question over the utility of these quite sort of spectacles of politicians visiting Taiwan. There's been a string of them, not just from the UK, but from the US and elsewhere too.
Yeah, but so I remember actually covering with you, Nancy Pelosi visit, and at the time we thought that the White House had said, please don't go. She went anyway, but she has a status, right? She represents something. Who does Liz Truss actually speak on behalf of, and what's been the Chinese reaction?
Absolutely. I think that's a really critical question here, because although we've seen quite a sort of robust rhetorical response. So Chinese embassy here, for example, called it a dangerous political show. Their Office for Taiwan Affairs has called it a farce. They've criticised the Taiwanese ruling party for using taxpayers' money to fund her trip, for example. But ultimately, we haven't seen that really provocative military response that we talked about a lot when Nancy Pelosi went. There is clearly a difference between a current US sitting Speaker of the House visiting and a former British PM, particularly one with such a short tenure.
Yeah, but your story was brilliant, Rebecca, so I urge everyone to go and see it. It's just also very awkward for the Prime Minister, Rishi Sunak. Thank you so much for a terrific update. And then, of course, we'll see when Liz Truss lands in Taiwan a little bit later what happens. We're just also getting some breaking news out of Tencent, so we have earnings out for the first quarter. I think if you look at revenue, it's actually a beat. Net income, though, missed. So it's reported a net income for the first time that missed the average analyst estimates. We'll have a lot more on where we're seeing some of the consensus beat and not. Prosus, we understand, has not really moved on that. Of course, this is a giant of the Chinese tech industry. And the bigger question going forward is how the US manages Tencent and whether there's a crackdown on some of these big giants. Now, UK business leaders, the Chancellor and the Governor of Bank of England will take centre stage this morning at the annual conference of the British Chamber of Commerce. Double-digit inflation, rising interest rates and plans to revive the economy will all be in sharp focus. Well, Lizzie Burden is at the event there in London with the head of the BCC. Lizzie, over to you.
Thank you, Francine. Well, speaking to business leaders as they grab their coffee and croissants before heading in to listen to Jeremy Hunt, I can sense they're frustrated. They feel like they're not being listened to by the government and that neither political party is giving enough of a positive vision for the post-Brexit economy. They want to know that they're being listened to and that they can be given a voice. So we're going to hear from Jeremy Hunt, Keir Starmer, the opposition Labour leader, and the Bank of England Governor Andrew Bailey today. But they also want to know that the British Chambers of Commerce can give them a voice after the exodus of members from the CBI. Well, I'm pleased to say that I'm joined now by the President of the British Chambers of Commerce, Martha Lane-Fox. Baroness Lane-Fox, thank you very much for joining me. We've had this slew of criticism of the UK by business leaders like Revolut, Dyson, most recently Stellantis. Is the government being ambitious enough, given the consequences, the economic consequences of Brexit?
I hear very different things on the ground. One of the most incredible joys about being President of the British Chambers of Commerce is, as you know, the Chambers is a local network joined up at a national level. So we represent people in their communities in the UK and then internationally as well. And what I sense is you're absolutely right, frustration, but I don't always recognise those comments from Dyson and Revolut. What I recognise is people who want to get on with their business, think the UK could be an incredible place to do that business, but they need certainty around some political waves that we've all faced over the last year about what the economic outlook is going to be and what will be the outshot of the general election. So there are still some pieces that are preventing people investing and preventing people really going for it in building their business, and that's important to get the growth.
Well, EU regulators have cleared Microsoft's acquisition of Activision. Is the UK regulators' approach a sign that Britain's closed for business?
I hope not. I understand why the CMA wants to make its mark and show that the UK is thinking about tech regulation, and I think we should be, but I also think that we have to be realistic, that we need to show these global businesses that are important for our growth and are important in the kind of network effects that they have, that we're here in open business. The UK Tech Sector is so vibrant, it's so exciting, it's completely different to when we started our business back in 1997. So I really hope that people realise there's a lot happening in this country and there's so much growth to achieve.
So lots of optimism from you, but many of your members are complaining that it's difficult to recruit.
Yes.
You've got the Home Secretary, Suella Braverman, saying that it should be Brits picking fruit and driving trucks rather than immigrants. Is she right?
That's the kind of toxic political issue, isn't it, to go straight to the fruit pickers. But I think the more fundamental question to me is the skills that we have, how we recruit people, how we retain them, how we retrain them for this brave new world. You're absolutely right. Every single business I have talked to in my role as President have said the same thing about people and skills. It's absolutely fundamental. I am an optimist because I'm an entrepreneur, but I am very pragmatic about where we're at right now. This is a perilous moment for the UK. We need people. We need trained people. We need people in the hospitality sector. We need people in the manufacturing sector. We need people in our technology sector.
So how do you do that in the short term?
I think in the short term we have got to open up our immigration system more. I believe that we need that. We also need to focus on training the workforce that we have, apprenticeships, different mechanisms that the BCC are calling for in our business manifesto. We need to make it easier for businesses to train people, to train up young people, but also to keep people in the businesses that they're already working in.
You've got the Bank of England Governor Andrew Bailey here today. We've still got double-digit inflation in the UK. Should some of your members be sacrificing profit margin for the good of the nation?
It's an interesting question. I think that people are facing tricky times in all of their businesses, particularly if you look at mid-scale and smaller businesses, which is not the only focus of the BCC, but it's a large percentage of that focus. And they are looking at continually rising energy costs, food supply costs, wage inflation, as we've just talked about. I think that people really are being realistic about their businesses, and what we need them to do is invest, not to be shy about being bold for the future for the UK. So I think it depends on the size and scale of your business.
So is it workers who need to stop asking for pay rises?
I think that we have a challenge around this kind of nexus of massive inflation in people's personal lives and therefore feeding into that business part of the economy. But fundamentally, if we can unlock more skills and we can unlock more growth, then all of these things become easier, right? So we've got to just get to a point where businesses feel as though they can invest for the future, where they feel more confident that the 5-10-year horizon in this country is one for growth, which we absolutely believe at the BCC. There is so much low-hanging fruit. Let me give you one example. One of the things that's staggered me since becoming president is, as you know, only 1 in 10 businesses do trade overseas in this country. If you're a member of the network, it's 60%, right? So that's just a huge opportunity to unlock growth in any scenario.
And finally, the CBI has had this exodus of members. Has their loss been your gain?
I wouldn't wish what's happened to the CBI on any organisation. And of course, as always, you want to think about the people that have faced really horrible situation in that organisation. The British Chambers of Commerce is here, open for business, as it has been since 1860. We're carrying on doing our job at a local, national and global level, and we really are a robust and phenomenally resilient organisation. We're here, we want to represent British business, let's get on with it.
Martha Lane Fox, President of the British Chambers of Commerce, thank you for joining me. Back to you, Francine.
Oh, I'm walking about.
Coming up, former ECB President Jean-Claude Trichet joins us for a good conversation as the ECB also marks its 25th anniversary next month. Stay with us for that interview. This is Bloomberg. Welcome back to Bloomberg Surveillance Early Edition. This is the Chancellor of the Exchequer, Jeremy Hunt, speaking at the BCC annual conference. Now, you can watch that live on LiveGo. If you have a Bloomberg terminal, we'll, of course, monitor every headline that he says, especially what people are trying to figure out is actually in terms of growth, in terms of how he sees inflation, how he sees revenue coming up. And then, of course, there's all the question of the VAT, whether there's a return to something that will be more advantageous for a lot of the travelers to come and shop and spend here. Now, in the lead up to the 25th anniversary of the ECB, the central bank is grappling with an inflation crisis and an unprecedented run of rate hikes. My next guest was at the helm of the European Central Bank for 8 years and a decade as the governor of the Banque de France. So here with me, former ECB President and European Chairman of the Trilateral Commission, Jean-Claude Trichet. Monsieur Trichet, thank you so much for joining us. I have a lot of questions on inflation and actually the real source of inflation. If you look at France and some of the dynamics in France, and we'll get on to European questions, but how much is public spending creating inflationary pressures in France, do you think?
Well, first of all, thank you for inviting me. It's a pleasure. I take it that in Europe in general and in France in particular, the main cause for inflation and the main cause for the differential between the inflation headline in Europe and in France and the headline in the US, for instance, is really oil, gas and food. It's absolutely clear. There we really have the difference between all European countries and the US, and it's easily explainable. War in Europe. The war is in Europe, not in the US. The US is very much self-sufficient as regards both food and energy. And that makes a fantastic competitive advantage. And when I look at headline, it's true for all European countries when compared with the US and my country in particular, but it's true, of course, for Europe as a whole. You have a full 2% difference between the headline in the US and in Europe when core inflation is the same.
Right.
The same in the US and in Europe, around 5.5, 5.6%. So it tells a lot on the difference between the US, the both sides of the Atlantic, in fact.
But how much, and I 100% understand that it's energy and of course some of those, the structural things that we're seeing maybe also to do with the transition. But we also spent a lot of money during COVID, giving actually, cash in people's pockets in certain parts of the world.
That's absolutely clear. My country in particular was with the whatever it takes, taking a very, very open position in this respect. But it was also the case when I look at the figures of the other advanced economy, frankly speaking, and the leader, perhaps paradoxically in some respect, because the absolute level of public spending as a proportion of GDP is inferior in the US to what it is in Europe. But nevertheless, the US was the most spender that you could imagine, which explains that Larry Summers, for instance, said at the very beginning of the new administration,
inflation's coming.
Beware of inflation, it will come. And it was not there, materialized. So, of course, he has a lot of credit for having said that. But the criticism was on the public spendings, on the fiscal decisions.
But, Monsieur Trichet, so we also heard from the Banque de France saying that actually there needs to be some kind of structural reforms to make sure that we address some of the supply constraints that would actually ease inflationary pressures. Like, if you look at the tools available, what would you do to reform some of the things?
Well, first of all, the government has been well inspired to improve or try to improve, and a lot has been done, obviously, on the labor market, flexibility, agility of the real economy of this country.
Raising the retirement age, which no one likes.
Well, that's another story. I must confess, I was myself very surprised that something which had been done in practically all other advanced economy, at least in Europe, and with some being at 65, 66, 67, on their way to 68 or more, was considered quasi-impossible in my country. Fortunately, the government took the decision to go through, and it was a must, obviously, even if, of course, it doesn't solve all problems. But it is a clear signal that reform are on their way in my country, and even if the political cost was enormous for the government and for the president, I think it was absolutely necessary, and I approve of what has been done, even if there is a large majority of the country against, for many reasons.
But, Monsieur Trichet, so given what you've explained on inflation and the difference between the US, is there a danger that the ECB is on the cusp of making some kind of policy mistake?
Well, you know, all decisions you take when you are a central banker, open market committee or council of governors, you have to weigh the pros and the cons of any decision you're taking. In my opinion, at the moment we are speaking, the ECB did correctly as regards the amplitude of the augmentation of interest rates, not negligible. They are now at 300 basis points, starting from minus 50 basis points. When they compare with the US, the difference is something like 200 basis points. So I can explain the difference between the US and Europe on the one hand, because clearly the demand shock is superior in Europe to what it is in the US. The supply shock is there, of course, in both cases, but the demand shock is superior. So part of the work of the ECB is done by this demand shock, if I may. So I can explain the difference between the US and Europe. Also to be taken into account at the present moment, the US think that maybe they will not go further. We will see what happens. In any case, they said that they are data dependent. In Europe, it is clearly said we are data dependent. We don't take any commitment, but
there's guidance.
The work is not terminated. That's clearly what they have said. And I can understand that, taking into account headline very high.
Is that confusing, that they're data dependent, but at the same time trying to guide the markets at the ECB?
I mean, frankly speaking, I prefer a central bank which says we are data dependent, and we don't exclude, of course, to increase rates, but we will see exactly where we stand, because we are also in a world which is dangerous. You had a number of banks in the US and in Switzerland that had problems and so forth. So I think it's wise to say that and not to commit in advance to a full-blown 25% basis point or 50 basis point. In my time, by the way, we gave signal that we would probably augment rates, but we were not committed to a particular decision. So I think what the ECB is doing is correct.
Yeah. Mr. Trichet, can you also, do you think that the deposit rate is restrictive yet? And this is something that, I mean, this is one of the big question marks, right? Because of all of the fine-tuning that could be needed.
Well, again, when they increase rates, they increase all rates, including the deposit rates. To the extent that liquidity remains extremely abundant, the real very short-term market rate is at the level of the deposit rate, which would not be the case, of course, in normal times. But we still have excess of liquidity, which pushes the very short-term rates down up to the deposit rate.
But so when does it become restrictive? Is there a figure, like how do you analyze so that you understand that actually it's pulling back?
Again, what counts is exactly where you stand, and it was explained very well by the various speakers, including Christine. You have to take into account absolutely everything. There is not one criteria. You have, she says, 3 criteria. In any case, you have to be sure that you are going regularly, progressively towards the 2%, which, by the way, Francine, 2% is the definition of price stability for all central banks of the advanced economy that are issuing currencies that are in the basket of the SDR. This is something extremely important. There is, at the global level, for those, I would say, currencies that are in the basket of the SDR, some kind of consensus on the goal. 2%.
You have to come back for an hour so that we look at whether 2% is really the right target, and we also talk about whether central banks can diverge.
I'm sure that what is important is the convergence of major central banks, again, of the advanced economy. But you know that the 5th currency is the Chinese currency in the basket of the SDR. And they are not far from that definition of price stability.
And then let's see what happens with the debt ceiling. Jean-Claude Trichet, you have to really come back, and we have to have an hour with you, a special Trichet show. Jean-Claude Trichet, there, the former ECB President and European Chairman of the Trilateral Commission. Now, coming up, we'll bring you some of the other corporate stories we're following this morning, including Pfizer. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, we just got some 10-cent earnings for the first quarter about 20 minutes ago. That means that they saw revenue grow at the fastest pace in more than a year, and that's really fueling some hopes that the world's largest online gaming and content arena will begin to accelerate after China's post-pandemic reopening. Now, this is a reminder, the most valuable company in China. It did barely grow its top line in 2022 because of regulatory crackdowns and COVID restrictions choking off consumer and corporate spending. The return now to growth suggests that there's an internet business like advertising and gaming that are emerging from this historic trough. And of course, this could have huge implications for others in the same space. We're also looking at Manchester United shares rising after Qatar is said to have improved the offer. So we have some good stories, and then we look at the U.S. debt ceiling. Bloomberg Surveillance Early Edition continues in the next hour, and this is Bloomberg.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Debt limit talks are ramping up between the White House and congressional aides. They hope to have a framework agreement by the time President Biden returns from his shortened trip to Asia. UBS estimates it will see an almost $35 billion gain from the takeover of Credit Suisse, but it warns there also could be billions in legal and regulatory costs. And a major shift in strategy for Tesla, perhaps. Elon Musk says the electric car company will dabble in advertising. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. And as European equity markets try and claw their way back into positive territory, Kriti, there's still a lot of the aftermath of yesterday's meetings on the debt ceiling to talk about.
Yeah, we're right back into wait and see mode, it seems. And I got to say, so are the markets, even as you have, of course, this picture of earnings that are continuing to come out. Anna, we have retail earnings continuing to come out today and for the next 9 days, to be sure. Nevertheless, futures really taking their cue from what you're seeing across the Atlantic, higher by about 0.3%. The bond market is fascinating, though, because remember, all week, and I want to say for the last few weeks, we've been talking about the 2-year yield testing that 4% level. Well, not only did it test it, it shot right back up through it. 2-year yield at 4.10, higher by about 2 basis points, but overnight and in the last simply 24 hours, the bond market has started to sell off. And that's really interesting, given that the bid into the bond market was largely driven by those debt ceiling talks, the irony of the full faith and credit of the United States at risk here, and yet here people are hopping into treasuries nonetheless. And with that move higher in yields, you are seeing the Bloomberg Dollar Index take its cue as well, higher by about 0.3%. A little bit of strength in the greenback, Anna, which I would say is having a marginally small ripple effect into the commodity space. NYMEX crude trading with a 70 handle, down only 0.1%. But I wonder how much of that is really a function of risk sentiment as we start to get closer and closer to the opening bells. I imagine the commodity complex will likely follow.
Yeah, an interesting relationship to think about, especially as we've seen iron ore prices pushing a little bit higher on Chinese demand, and maybe that's something to watch when it comes to London and the mining stocks. More on that in a moment. This is the picture then across Europe, and Kriti, it does look pretty range-bound, quite a bit of grey on this screen today. But we have been in more negative territory than this earlier on in the session, and we're clawing our way back, as I said, to sort of the flat line. The Xetra DAX over in Germany outperforms a little bit. More on that in just a moment. But here's the basic resource sector. I can show you where we are there, because this is the best performing sector, actually, across European equity markets, up by 0.6% on those mining names, taking into account what we're seeing in China and demand for iron ore, perhaps. The London Stock Exchange is down by 4%. We've seen some key shareholders selling down their stakes in this business. That news came last night after the close, and so that being priced in, the price at which they are selling then being reflected this morning in the price of the shares in the London Stock Exchange. Also weighing on sentiment in the sector is the earnings that we've gone out from Euronext, a competitor, a contemporary in that sector. And so as a result, we're a little weaker there. Commerzbank down by 6.2% in Germany. More on this story a little bit later in the programme, but we are focused here on this because they had guided higher in terms of net interest income and what that could deliver for the business, but resisted the temptation to guide entirely higher for the whole business for this year. And so maybe that was a little underwhelming to some investors. And Siemens, though, providing a counter to that over in Germany, heavily weighted in Germany, of course, up by 2.2%. They're sitting on very strong order backlogs. They expect that order picture to normalise from here, Kriti, but certainly the rearview mirror has looked very strong for Siemens.
Certainly something we're keeping our eye on. But of course, Anna, around the world, all eyes still going to be on the debt ceiling conversation, which again feels like it's on pause. President Biden and House Speaker Kevin McCarthy are expressing cautious optimism that they can reach a deal on raising that debt limit that would avert a potentially catastrophic default. Biden spoke after the talks yesterday.
We just finished another good, productive meeting with our congressional leadership about a path forward to make sure that America does not default on its debt for the first time in history. There's still work to do, but I made it clear to the Speaker and others that we'll speak regularly over the next several days, and the staff's going to continue meeting daily to make sure we do not default.
Zach Goen, Bloomberg government reporter, joins us now in D.C. for more. Zach, thank you for waking up early for us. Walk us through the developments here. It feels like now with the G7 summit, all things are on pause. What are the next steps from here?
This really is crunch time for President Joe Biden and House Speaker Kevin McCarthy, who for months have been at the center of this negotiation or existential standoff over the U.S. government borrowing capacity. As you mentioned, President Biden is leaving for Asia this week and has actually shortened his trip as a deal is still elusive between Biden and McCarthy, who's the leader of the House Republicans and sort of the other end of the ideological spectrum here in Washington. And so while Biden's going to be out in Asia, some key staff plan to meet daily, the president said. People from the White House, from the Speaker's office, as well as Congressman Garrett Graves of Louisiana, a trusted confidant of Kevin McCarthy, to try to hash out an agreement. But time is really running short. McCarthy was saying that they really need to reach a deal by this week in order to get one through Congress, both the House as well as the Senate.
I was speaking to one of our colleagues over in Asia earlier on who's been following this from there. And really interesting, the take that he was giving me was that, sure, you need to get what you want in the room, but then you have to make sure that this is going to get passed by lawmakers. And so if you kind of win too much in the room, you risk that the other side will reject it once it comes out of the negotiating room and back to the floor. Zach, what kind of considerations like that are you following in Washington?
Certainly, if Biden and McCarthy have particular positions on this, they still need to keep in mind that they have to assuage their parties in order to pass this. McCarthy is the head of a very narrow Republican conference, only a 5-seat majority, whereas Democrats hold the Senate. And even in the Senate, where Senate Republicans wield the filibuster, the sort of expectation that any legislation would have at least bipartisan support, that will need to be hurdled as well. And so any deal that comes between Biden and McCarthy will have to win the support of at least enough members of both parties in order to get something across the finish line. I was talking to one Republican congressman yesterday who said, quote unquote, the worst case scenario is something of a fiscal Republican, was saying that, a cleaner debt ceiling gets through from the Senate, goes over to the House, and then eventually goes up for a vote with mostly Democratic support. And again, Democrats have been calling for a debt ceiling with fewer positions attached to it, along with maybe a handful of Republicans as well. And so there's some really tricky balancing act happening in both parties, but especially for Kevin McCarthy, who, of course, could lose his seat as Speaker if enough Republicans see that he has capitulated too much to the Biden administration.
Certainly a lot at stake. Zach, that's on the, of course, domestic policy front. Let's talk about the international policy. Of course, Biden headed towards the G7 right now. A shortened trip, but nonetheless, he is due in Japan. What is on the agenda there? Anything that could really change the foreign policy agenda?
Certainly, he's going to the G7 in Japan. That is sort of the main reason for the trip. And that is going to be the key meeting. Of course, the Australia and I believe the Papua New Guinea stops have been canceled, which obviously they're not going to be happy about. But Biden is in a very different position than he was the last time he made a similar trip. That was, in the aftermath of the midterms, where he was sort of riding high after Democrats certainly lost the House of Representatives, but by a much narrower margin than analysts were expecting. And this time, he's going in something of a weaker position. He doesn't really have the political backing that he did a year ago. And so it might make it trickier to reach any sort of positions with some of our key international allies.
Zach, thanks very much. Zach Cohen of Bloomberg Government, thanks very much for joining us. On to the banking sector then now. UBS is offering more clues to investors as to how its emergency takeover of Credit Suisse will translate into near-term profits. Filings overnight project a massive accounting gain from the merger, as well as billions in potential legal and regulatory costs. How do the two balance out, of course, is key. Bloomberg Finance Editor Tom Metcalf joins us now on set here in London. Tom, very good morning to you. So how do we interpret the numbers then in these filings?
Well, they're very big, as was expected. So on the sort of bad will side, which is actually a good thing for UBS's short-term profit, that's about $34.8 billion. And then they are saying, though, hey, in the next 12 months, we expect, because of the Credit Suisse, sort of these litigation things we're going to inherit, that's about a $4 billion hit to capital. So everyone was expecting this big sort of, it's effectively an accounting gimmick. But what will happen in Q2 is, and these numbers could still shift, that UBS made that very clear, is there's going to be an absolutely enormous profit, at least on paper, for UBS. That's good. I think, though, if you sort of zoom out a little bit, I think they could even set a higher number. So that's quite interesting. If you look at Credit Suisse's book value, that was up to 50 billion. So just an interesting sort of little tea leaf reading you can do from it.
So that is the Swiss story. Let's talk about the British/Parisian story. Barclays adding 200 new jobs in Paris. Tom, it feels like the big fear is that Paris is going to take over London as a major financial center in the post-Brexit era. What's the strategy there? Is that what's happening?
So look, there's definitely been a steady drumbeat of news. Lots of banks are, kind of saying they're investing in Paris, and certainly that's becoming one of the EU's big financial centres. It's attracting a lot of traders, as today's news from Barclays says. I think you put it in context against just how big London still is, something like 300,000 financiers. This is sort of not good news for London, but certainly not terminal or anything like that. And I think what it points to is a future where London is still a global, massive financial centre, but the EU just has that little bit of heft on its own.
Okay, Tom, thanks very much. Interesting to watch those shifts. Tom Metcalf joining us there with financial services news. Sticking with the banking theme, Commerzbank shares are falling, as we mentioned a little earlier on in the programme. The German lender's upgrade to its outlook for specifically full-year net interest income perhaps disappointed analysts and investors. I spoke with the CFO, Bettina Orlop, earlier.
I think we can be all grateful for all the changes we have done over the past years since the financial crisis, because we are much more resilient, much more stable than we have been a couple of years ago. Speaking for Commerzbank, I mean, we have very, very strong ratios, very high profitability by now for really absorbing potential shocks.
And we go, of course, from Germany to what's turning into a very quickly an international story. Tesla also edging higher in the pre-market. Elon Musk says the electric car maker will dabble in advertising, a shift for the company that's largely avoided traditional marketing. Joining us now to discuss more of the takeaways from Tesla's annual meeting is Bloomberg Auto editor Elizabeth Behrman. Elizabeth, how significant is the decision on advertising? We know that Elon Musk and Tesla broadly is trying to kind of appeal to the more general consumer as opposed to your classic Tesla luxury vehicle. Is that the strategy here?
Yeah, part of it, absolutely. I mean, what this move, and we don't know how significant the advertising push is going to be yet, what this move is telling us that Tesla is becoming a much more mainstream kind of a car maker. They're now making, or set to make rather, about 1.8 million vehicles this year. That puts them kind of in the same league as BMW. At the same time, you've got a lot more competition. A lot more car makers are bringing out competitive EVs. And the market is also weakening. Tesla itself has been driving major price cuts across the industry. So also trying to broaden out the market that they're addressing with advertising seems to be a smart step. And like you were saying, so far, Tesla has been relying on word of mouth, Musk's huge persona on Twitter. But yeah, if they want to tap the mainstream a bit more, advertising seems to be a good step.
Yeah, really interesting to see what kind of messages they want to put across then in that kind of advertising push, and how well thought through it is, or whether that was sort of a plan made on the hoof yesterday from Elon Musk. Now, thinking of Elon Musk and his relationship with shareholders more generally then, Elizabeth, has he done enough to reassure shareholders that he's back in charge of the business? I mean, not that he went away, but he certainly has been more distracted by other business ventures.
Yeah, the distraction, especially with, of course, the takeover of Twitter last year, was a key feature worrying shareholders. And of course, as we know, he's already appointed a CEO to run things at Twitter. But he is going to remain pretty hands-on driving that business. He's remaining as executive chairman. So how he's going to be dividing his time in future is not really clear yet. Shareholders, of course, have always been worried also about a lack of succession planning at Tesla, with the company being pretty much a one-man show in terms of its public, its publicity anyway. So on that, Tesla didn't really provide any more insights other than Musk telling us that he plans to stay on as CEO.
Okay, Elizabeth, thanks very much. Elizabeth Behrman joining us there with the latest on Tesla. Coming up on the programme, we'll talk about markets and their positioning, the run-up to further debt ceiling conversations. Pooja Kumra joins us, Senior European and UK rate strategist at Toronto-Dominion Bank. How is she thinking about the scenarios that could play out from here? And Fed officials are open to a June pause, but also haven't ruled out further hikes. Richmond Fed President Tom Barkin spoke in an interview with Bloomberg's Michael McKee.
I do want to learn more about what's happening with all these lagged effects, but I also want to reduce inflation. And if more increases are what's necessary to do that, I'm comfortable doing that.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Look, we're waiting for news on the macro front when it comes to the debt ceiling. We're waiting for earnings that are going to kick off with the retail story later in throughout the day. But what does that mean for the S&P 500? What does that mean for the benchmark? If really all the volatility is kind of concentrated in the bond market, in the FX market, well, here's what it shows. For our radio audience, stick with me here. We're looking at a very basic chart of the S&P 500. It goes back about a year, and you really can go all the way back to about October of 2022 and see where the market's bottomed out. It's been a little bit of an uptrend since then, a few hiccups, a few technical corrections on the way there, but you have seen quite a big reversal, getting us almost back to the levels we were at before that major 20% bear market that we saw last year, the carnage in the equity market. But now what? For the last 2 months or so, we have been in a solid trading range, remaining range bound, even as we've had earnings beat to the upside and had some pretty big scares to the downside. Things like the banking turmoil, for example, and what that looks like on the more macro stage. Nevertheless, what changes that? Let's ask a true expert. Joining us now from Paris is Phil Serafino, Bloomberg senior markets editor. Phil, in a range bound market, what changes the game?
Yeah, I mean, it really does feel like the market is on hold. I think what investors want to see now is some concrete signs that inflation is really under control. You know, the market has been betting that the Fed not only will pause in June, but maybe is done for good in this hiking cycle. And hey, maybe they'll be cutting rates before the year is over. But if inflation comes in hotter than expected over the next few months, that scenario is off the table, and that's going to undermine the market. If that scenario does come true, if it does look like the Fed is ahead of the curve and can pause and maybe cut rates, that would give the all clear sign. But, you know, the inflation's a monthly indicator, right? And we're waiting for the next one, and we're waiting for more signals from the Fed. So the market is just really in this waiting period at this point.
We're always waiting for something, Phil. We certainly are a bit listless, aren't we? Waiting for progress on the debt ceiling, waiting for more direction from the Fed. What does market leadership tell us? If you sort of dig beneath the surface and work out what's leading trends in markets, does that shed any light?
Yeah, I was looking at the S&P 500 since the quarter started, and the worst performers are energy, materials, real estate, industrials, all the kinds of stocks that really need a healthy economy. So the market for now is betting that, you know, serious slowdown, if not a recession this year. That's not necessarily the end of the world, though. If, like I said, if the Fed decides they're done cutting rates, raising rates, or if they even can cut rates this year, that could turn around quickly. But for now, the market is pretty pessimistic about the outlook for the economy.
See, pessimistic in terms of sentiment, perhaps, but would you say that they're still pessimistic in terms of the fact that they haven't sold off more? A lot of people are saying that, well, look, the full effects of the rate hike aren't fully priced in, and the market has it wrong because they're not looking at the hikes, they're looking at these potential cuts in the future.
Right. I mean, there is a case to be made that the market is far too optimistic. You know, the S&P 500 is up for the year. People think it's going to be a soft landing. It's all going to work out. If that turns out to be wrong, then yeah, there's a lot more downside for that market.
Phil, thanks very much. Bloomberg's Phil Serafino joining us there with thoughts on the markets. For more market analysis, check out the Markets Live blog, MLIV Go. That's the function to use on your Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. The White House doesn't plan on asking Congress for more money for Ukraine the rest of the fiscal year. A White House spokesperson told CNN that thanks to bipartisan congressional support, the U.S. has the resources it needs for Ukraine for now, but that will be reevaluated. Theranos founder Elizabeth Holmes has lost her final request to stay out of prison while she appeals her fraud conviction. The U.S. Court of Appeals in San Francisco ruled Tuesday. That means Holmes will have to report to prison soon. She was sentenced to more than 11 years behind bars for defrauding investors in her blood testing startup. Former Vice President Mike Pence is calling for an end to the Fed's dual mandate. He says the central bank should focus only on fighting inflation and leave jobs creation to Congress and the president. Pence told Bloomberg the Fed should return to its historic mission of ensuring sound monetary policy. He's considering challenging Donald Trump for the Republican nomination next year. BlackRock is calling employees back to offices at least 4 days a week. In a memo to staff, the world's largest asset manager said it has found benefits from working together in person after the pandemic. BlackRock's new policy begins September 11th. And a controversial take from BlackRock to have people come into the office 4 days a week when even here on Wall Street, I think about 3 days a week is the norm, with I think Morgan Stanley pushing for 5. And even that was met with some resistance.
Yes, we got that news from BlackRock. AT&T, I know, also talking about 3 days for managers to return to the office in a totally different sector, of course. I was drawn to the comments from Elon Musk, as it's often the case that one is. Kriti, he says that it's morally dubious to work from home. It's an affront to factory workers and those who have to show up to the office. I suppose sentiments that we can relate to. But more broadly, interesting to see also that a survey by Challenge Gray and Christmas shows that US workers are less willing now to move for new jobs, partly to do with the work from home trend and also the cost of moving with the rising interest rate environment.
Yeah, and what does that do to some of the major cities around the world? We know that New York City, for example, is still dealing with a lot of the lack of revenue that comes as a product of that, and I'm sure that's the case for many of the capitals around the world.
Yeah, indeed. Although some stats suggest that maybe in Europe there has been a bit more of that drive back to the office than there has been in the United States. I think that's what some of the real estate stats show us. But let's put that to one side and talk about the macro picture, the debt ceiling debate. We'll talk to Pooja Kumar shortly, senior European and UK rate strategist at Toronto Dominion Bank. She joins us in a moment here on the programme. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Debt limit talks are ramping up between White House and congressional aides. They hope to have a framework agreement by the time President Biden returns from a shortened trip to Asia. UBS estimates it will see an almost $35 billion gain from the takeover of Credit Suisse, but it warns there also could be billions in legal and regulatory costs. And a shift in strategy for Tesla. Elon Musk says the electric car company will dabble in advertising. I'm Kriti Gupta in New York with Anna Edwards in London. Anna, a deluge of stories, even though on the macro front we seem to be waiting. On the micro front, Tesla catching everyone's attention.
Yeah, so a lot of corporate stories to think about, but yeah, a little bit listless at the overall market level, Kriti. And let's get into that, shall we now? We've got the Stocks Europe 600 down by 0.1%, clawing our way back from negative territory, back towards the flat line as US futures have improved over the last few hours in a general sense. The London Stock Exchange is down by 4%. We saw after hours yesterday an announcement that some core shareholders there were going to be selling down their stakes further in that business and doing so at a lower than market price. So as a result, we see some weakness in that share price. Commerzbank is down by just over 7%. They have actually upgraded their guidance for net interest income over at the German lender, and they paint a quite positive picture about the German economy right now. They're not actually seeing so much in terms of the cracks in the German economy that maybe we were looking for when we look at investor sentiment on the ZEW level. That seems to be pretty negative. But Commerzbank telling us a positive story, but maybe those upgrades not enough for the market that had already priced in some better performance, I suppose, around NII. And Siemens is up by 2.25%, so that providing some counterweight in terms of the German corporate narrative today. And it's such a heavy weight over in Germany, of course, helping the German market to relatively outperform. They have also upgraded their guidance. They are expecting the orders to normalise a little bit, Kriti, but they've been sitting on a really strong order backlog.
An interesting corporate story for sure. And as we see the tape really reversing in Europe, it's a similar story here in the States as well, although perhaps to a smaller margin. Futures only higher by 0.2%. So pairing some of those gains in just the last 30 minutes or so that we have been on air. And in the same vein, you are starting to see a little bit of a move into the bond market. Remember, 30 minutes ago, we talked about the Treasury yield being about 2 basis points higher on the front end of the curve. Now we're looking at 4.08 on the 2-year yield. So again, a little bit of flow entering the bond market. And I would say entering the FX market as well, really taking its cue from those interest rate differentials. Bloomberg Dollar Index, again, pairing some of its strength as well, only stronger by about 0.3% at the moment. Again, no real conviction. The idea of a listless macro market is still top of mind for a lot of investors around the world, really. NYMEX crude, though, we are starting to flirt with the idea of NYMEX back into the 60s. That is a scary level for anyone who's saying crude is going to be a recession indicator. But really, how much of that commodity is really taking its cue from the risk sentiment around the world? That's going to be my question. Nevertheless, 70 handle on that commodity. Anna.
OK, let's get into a conversation about how we're positioned in these sort of listless markets. One of the reasons we are a little listless is we're waiting for progress on the debt ceiling talks. Pooja Kumar joins us, senior European and UK rate strategist at Toronto Dominion Bank. And Pooja, you can't help but have a view on what's going on the debt ceiling right now, given how dominant it would be in terms of market thinking if we did see the US go through that X date and default. What is your base case thinking and how do you position accordingly?
Yes, so I think today's at least markets is taking some relief given the fact that we've had some progress in terms of conversation. US CDX is coming down. We still believe that there would be a short-term deal, ideally till September. Best for markets will be if they can actually push out the debt ceiling after the elections. At least it removes the near-term risk. But I think given the fact that even Biden is heading back, he has shortened his trip, it basically suggests we are all back to action. And I think that's where markets are a bit in a pause mode. At least we are not seeing overreactions. Other than the bills market, the general market pricing for debt ceiling is pretty much muted right now. But there is a tail risk event that we don't want to avoid. I think in terms of positioning, answering that question, I think the way to handle even the Fed as well as with respect to the debt ceiling risk, we do like holding a bull steepening view for 2-10 treasury curve, just given the fact that uncertainty around the economy as well as what actions Fed might have to take due to debt ceiling would actually support the front end of the curve. And
Okay,
hence the
yes, I
steepener.
wanted to ask you. Right, yes, I wanted to ask you about that. What it is that would drive treasuries if we do get very close to a default, or even if we did see a default, Pooja. I mean, perhaps counterintuitively, I know a lot of people, you included, think this does produce a bid for some treasuries, but where? Not the short end, maybe the longer end, as it just becomes a question of time until you're paid by the US government. Is that how the market is thinking about this?
Yes, I would agree with that. And I think it basically is a safe haven bid. And this is something that we saw even previously when we did see the debt ceiling in 2012-11 actually reaching this level. So at that stage, even when S&P downgraded US, we did see that bid coming to treasuries because that is supposed to be the safest asset. So I think that's how markets are positioning. But I think given if we do get a deal, the focus again will turn for what is Fed doing next. And we do have a lot of data points that markets as well as the Fed need to absorb before the June meeting.
Pooja, what is the read-through then into the European rates picture? Of course, we know that treasuries are kind of the benchmark for global rates around the world. We're already seeing the volatility, as you point out, kind of injected into that asset class. What is the read-through into global markets?
I think with respect to global markets, the Fed has actually, treasuries have actually put a lid as to how much rates can sell off. Just looking at the case of bonds, ECB has been so hawkish, they actually ended their APP portfolio. They have suggested that they have much more ground to cover, but markets are not pricing that much in terms of terminal expectations. Terminal expectations are still hovering around 3.6. And the general consensus is that ECB could go even at 4%. So yes, treasuries just it basically limits how much we can sell off. But I think the front end of euro curves or even the sterling curves will be driven by the general rate expectation. And I think that's where we could see bond curves continue to bear flatten. And this should be opposite theme than what we are seeing in treasuries, where steepening should be the theme, just given the fact that we have an endpoint when it comes to terminal rate expectations.
Pooja, so you kind of outlined it there, but I'll ask more directly. What's the trade here? If you're trying to hedge this unthinkable scenario of a U.S. debt default at the end of the day in just a few weeks, is it as simple as some sort of flight out of the United States? We had a guest on Bloomberg Radio, for example, yesterday saying that, in fact, it is the UK and German bond markets that might actually benefit from, ironically, a flight to quality in a U.S. debt default. Do you see something like that happening?
I think if when it comes to debt ceiling, if no deal is the case, then US will benefit along with the other countries as well. As you said, we are also classified as safe haven, and most of the countries, 60% of world reserves are in USD. So I don't believe that those reserves will get removed, but actually markets will look at euro as well as GBP. I think in terms of where I see more value is more in GBP rates, just because we have sold off a lot. But needless to say, euro and GBP both will benefit if we do come to a point where we cannot get to the debt ceiling. So in bonds, I would actually hold being long 10-year bonds for a risk off move, and also hold tighteners in gilts versus bonds, just given the fact that gilts have really sold off a lot on back of the recent UK data.
Pooja, can I get your thoughts on Europe, given you're spending time with us this morning, and that is your core area of focus? I know that Decause, European Central Bank policymaker, Governing Council member, has been talking about how he thinks that we are nearing the end of the tightening cycle in the Eurozone. And it's interesting, he goes on to say how he thinks that the transmission mechanism is working strongly in Europe. What are your thoughts on how far through the process the ECB is?
So with respect to ECB guidance, I think they have been pretty much clear when it comes to saying that they have a lot of ground to cover. And they did not change their entire bias there. So we do feel that possibly markets should take this as 2 more hikes that will be incoming. But where we are seeing what is changing when it comes to dynamics in Europe is the bank lending survey. The credit conditions have started to tighten significantly in the last couple of months, and primarily it was driven by US banking sector crisis as well. So if the US credit conditions do stabilize, which is something that we are seeing right now, I think Europe should also be in a better position, and that should allow ECB to actually at least hike 2 more times. And I think if things go worse, and if Fed has to pause as soon as in June, I think that's where I would be a bit cautious as to whether ECB can actually hike twice or whether June could be their last hike.
And in that same vein of thinking, Pooja, let's put some numbers on it. About 6 weeks until we get to the half-point mark of 2023. What's your forecast for the 10-year on both sides of the Atlantic?
So for Euro, we are actually looking for bonds to end the year at 2%. And it's primarily driven, again, by our scenario that US does go into recession by end 2024. By end 2023. And for treasuries, we are looking for them to end the year at 2.75. So I think when you're looking about our strategic trades, we do like holding long US versus bonds. We do expect this spread to tighten to 75 basis points, which is something that we have not seen. And it will be interesting to see those times.
Okay, Pooja, thanks so much. Pooja Kumra of Toronto Dominion Bank, thanks for your time this morning. Coming up, we'll stick with the theme of the debt ceiling. Elliot Hentov joins us, State Street Global Advisors, Head of Macro Policy Research. This is Bloomberg.
Mr. Speaker,
Yes.
you said earlier this week that you were still very far apart.
We are. It is possible to get a deal by the end of the week. It's not that difficult to get to an agreement. When you think about Limit, Save, Grow, the bill we passed, we raised the debt ceiling. We cap future spendings.
That's House Speaker Kevin McCarthy, of course, striking an optimistic tone after debt ceiling talks yesterday. A deal would avert a potentially catastrophic default. Negotiators want to come up with a framework agreement by the time the president returns from a shortened trip to Asia. Let's get another investor perspective on this. Elliot Hentov joins us, Head of Macro Policy Research at State Street Global Advisors. Elliot, very nice to have you with us, and really good time to check in with you and get your thoughts. You mentioned in your notes ahead of our conversation that the downside risks are much greater than ever, I think connected with the debt ceiling. Maybe is that exclusively with the debt ceiling? I'm not sure. But why so? Why is it more now than 2011? Or why do you see such a negative picture?
Well, clearly brinkmanship is at a very different level than it was even 12 years ago. So the downside scenarios, although the risk looks a little bit smaller, if you follow the play-by-play, are greater than ever. Because I think that the political appetite, the incentive structure in U.S. politics is such that, you know, not only going all the way to midnight, but even a couple minutes past midnight is thinkable. It was unthinkable a while back. So it's simply become thinkable.
Okay, which is an interesting place to think about being. If we do get a deal, and that does seem to be a lot of our guest's base case, that we will get some kind of agreement between the two sides, that still might result in fiscal spending being cut back, because that might be the price that the Biden administration has to pay to get Republican support. So what is your thinking around that, around a fiscal pullback? How substantial would that be and meaningful?
Frankly, that should be the core question for investors' mind. What's the magnitude of fiscal contraction? If we could compare it with previous episodes, the problem this time is that the economic cycle is turning. So by Q3, it's very obvious we will be in a very decelerating, perhaps even slowing or even contracting U.S. economy. if any type of fiscal headwinds in that context matter much more than when you had 2011, when you basically had a recovery still on track, and then you got a fiscal contraction. But remember, even 2011, the economy was recovering. The fiscal deal shaved off quite a bit of growth in 2012 and 13. It was a headwind for equities, even though otherwise macro environment was relatively stable. So yes, the question is, what's the magnitude of cuts? The Republican draft plan would be severe, would be absolutely austerity 2.0 on steroids. But even a fraction of that would be quite a headwind.
Okay, Kriti, jump in.
Austerity 2.0 on steroids. That is quite the statement. Elliot, in a previous life, you used to work at S&P 500. Standard & Poor's. I'm going to start over. Standard & Poor's. I want to ask you about the potential of a credit downgrade here. What does that process look like? Even if we do get a deal at the end of the day, we've had Fitch Ratings, for example, in the last couple of months say, look, a credit downgrade is something that could be in the cards.
I think for the two main rating agencies that have kept the AAA rating, one of them has been fairly clear that a credit downgrade requires a trigger, and the trigger would be some type of unprecedented event. So in this case, this presumably means that we move past the X date and the Treasury starts prioritizing payments and perhaps delays payments to suppliers, employees, all sorts of other recipients that are not bondholders. So I think Fitch has clearly stated that that would be enough of a trigger to lower the rating from AAA to AA+. So that is one of the risks, and that has its own dynamic. Once that happens, that has trigger reactions thereafter.
Is that the contingency plan that would kind of be the go-to should we get close to that X date and still not have any deal?
That is clearly the contingency plan, and frankly, a lot of officials have looked into the technical and operational abilities of maintaining such a prioritization plan. You know, basically putting in place targeted directions to make sure that payments go to bondholders on time, exactly as planned, while basically withholding payments elsewhere. The worry here is that there's some operational risk. None of us can see into this black box. I think that's something that the market would be very nervous about, and rightly so, because even a technical default would be quite severe, even if it was an accidental operational mistake.
Yes, I remember from times gone past where even the consideration of those prioritization decisions has become a really tense thing for the markets. What are you seeing? I know that at State Street you have a lot of data on the flow for professional investors, where their money is going. I wonder what that tells you, because everything we've been talking about suggests a really risk-off mood in markets. Is that reflected in the flow data? Tie these things together for us.
It is. By and large, from our flow data, from our custody banking business, we see that institutional investors are very much positioned for risk off, not only around the debt ceiling. They've been like this for several months. It's actually quite a long period of risk off positioning. Frankly, in terms of duration, probably the longest we've seen since the financial crisis.
So not just about debt and not just about banking then? Predates that?
Yeah, absolutely. It predates that. It's obviously the March events in banking exacerbated that. Recent weeks clearly are pushing but what the contrast here is with market pricing. Pricing has not moved in such a risk-off mode to the same degree that as institutional investors are feeling. So something's got to give. Either price action will catch up with that, or institutional investor risk appetite will return.
Okay, so maybe these markets don't stay listless for long. Elliot, thank you very much. Thanks for joining us. Elliot Hentov of State Street Global Advisors. Coming up, more retail earnings on the way, with Target and TJX set to report before the opening bell. We will get a preview next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. I want to get a quick look at some of the stocks we're watching in pre-market trading in the United States. A quick check on the banks, Anna. Western Alliance and PacWest, both higher in the pre-market by a massive margin. 10 to 11% gains in both stocks. This comes after Western Alliance really comes in higher with their deposits. The idea here that Jamie Dimon had outlined over at JP Morgan, that some of this deposit flow to the larger banks would reverse throughout the end of the year. We're already seeing signs of that with some of those those regional banks that took quite a bit of a hit. Another major stock mover this morning, Tesla shares, they are higher as well, to the tune of about 1.5%. TSLA is our ticker for our radio audience. This comes after their annual meeting yesterday and, of course, an interview yesterday evening with Elon Musk. The idea here simply being that, look, Elon Musk may look to put more investment into advertising for Tesla, perhaps a lesson he's learning from his time over at Twitter as well, something that we're going to be monitoring very quickly as Tesla really attempts to scale up when it comes to their EV production. So those shares, again, higher by 1.5%. But I got to say, the real stock story this morning is all about retail. Target shares and TJX, they are both going to be reporting in the pre-market. Target shares higher by 0.3%. TGT is your ticker there. Looks like TJX is unchanged at the moment. We're going to keep an eye on those shares because, again, we need to see what they actually tell us about the consumer. For more of a little bit of a preview, Bloomberg Simone Foxman joins us first thing in the morning. We heard from Home Depot yesterday. What are we going to hear from Target and TJX today?
There was a clear message from Home Depot yesterday. Consumers are shopping less and they're spending less each time they do, and we're going to see how that influences Target and TJX. Now, what we could see here is a bit of a divergence between those two companies. Target, beneficiary of a little higher income spending. We could see people switch down a little bit. Target was a huge beneficiary, as you can see by this GTV chart, of the pandemic spending when people were sitting at home and shopping online. TJX was not as much. You can see that down there in the blue. But they are the owner of Marshall's TJ Maxx. We saw people switching down. They could switch to TJX. And, you know, thinking about Home Depot, home improvement's a little bit of its own story, correlated to some degree with activity in the housing market. So these are going to be a little bit more consumer spending.
Good morning to you, Simone. So what factors are analysts going to be looking out for then that go beyond the simple measures like traffic to these stores and spending patterns? Are there other sort of themes to watch?
Yeah, absolutely. I mean, with Target, we're going to be really focused on margins. We've seen spending increase in categories like household necessities, like food and beverage over the past couple of quarters. And we continue to expect that to increase, but the margins on those businesses are really low. And Target's really felt the pressure from things like apparel, home electronics, all that kind of stuff. We expect same-store sales to slow, profit to drop almost 20% from a year ago. From TJX, a little bit of a different story there. There's some issues with theft. It had some particularly high theft charges in the fourth quarter of last year. But we're also looking for how it makes use of an inventory glut in the market. There were a lot of retailers with a lot of nice stuff. That stuff could go to places like TJ Maxx, could go to Marshall's, and then consumers could make use of that, again, as they switch potentially into stuff that's just priced a little bit less.
Of course, the inventory story, crucial, and not to mention the inventory clear out, how much of that goes straight to the Target dollar section, which I hear nobody really knows about. Bloomberg Simone Foxman, we thank you, as always, for waking us up early and walking us through that. Of course, that does it for Early Edition. Surveillance is ahead. Tom, John, and Lisa take it from here. We're going to hear from Margie Patel of Allspring Global Investments. She is among another lineup of guests. Amy Wu Silverman over at RBC Capital Markets, Terry Haynes of Pangea Policy, and Mike Schumacher over at Wells Fargo. Just some of the names you want to hear from as they all kind of balance the macro and micro narrative. Stick with us. This is Bloomberg.